All right, welcome, guys. So this is the DeFi investor panel, and while I know you guys pretty well, we've done a number of deals together and see you in the space a lot. I think probably this may be like the most active, least known group of investors in the space at this stage. So I think there was an earlier like crypto investor panel, folks were doing DeFi, got like $100 million funds and all that kind of fun stuff. I think the goal here is let's hear a little bit about how everyone is doing their DeFi fund, and maybe just like quick 1 minute intro, and then let's chat. I think there's some fun things that I've talked about with each of you individually that I think would be good to have little group conversations about, but let's do this as a conversation, not like me asking you all the questions and everyone just going down the line sort of thing.
Yeah, it's a great idea. I'll kick it off. So we started a fund called Synapse Capital. We got into crypto about 7-8 years ago. It was really kind of the point Ethereum came out that, coming from a developer background, we saw the potential there for developer communities to really take it to the next level. And so with that, I mean, we ended up kind of in DeFi more organically than a decision. Obviously, DeFi is only a relatively recent term. But a lot of the earlier projects like MakerDAO, even 0x, we're super excited about. And part of it too is the ability to like really engage the crypto community. So that's where we've been focused, and kind of focused across the decentralized finance spaces, as well as on projects that are really bringing those paradigms to the front.
Cool.
No, I'll go next. So this is Ben with Verify. We're a DeFi-focused fund. Our approach is to both invest in the projects and also provide liquidity and kind of become power users of their protocol. And it's an interesting time to do that with liquidity mining, starting on Balancer and Compound and some of the other protocols. I'm sure we'll talk about that today. My background is originally in structured finance and credit, which I didn't anticipate this when I made the jump into crypto, but it's actually kind of come in handy to understand financial products when looking at these protocols. Super excited to be part of the discussion tonight.
I'm Vance Spencer. I, alongside my partner Michael, lead Framework, which is a DeFi-focused fund. I think what we're best known for is being very active in the network we invest in, being aggressive and unconventional with the risk that we take, not just investing in fast, but doing other later stage things with the network. I think between the four of us, this is pretty much the early stage DeFi ecosystem here.
Yeah, Vance, we're having a little trouble hearing you. So I don't know if you can adjust the mic you're using or something. That might help. But I think we did get the gist of it there. And then Ideal Cola Ventures, we're still more of a bit of a general crypto fund, but we have been doing a lot of DeFi over the past year, and we recently announced a product validation day focused on early stage DeFi projects. We got over 100 applications for that from some really, really awesome groups, and then we're going to be doing a little DeFi residency program. But we're excited about this. And so, what I wanted to jump in is like first, for all of you, I know you don't just invest in projects, right? You tend to all get pretty hands-on, but like the number one thing that a lot of these early stage projects are looking for is liquidity. So like, how do you think about supporting these projects with liquidity, and then how do you balance that across an increasing portfolio of projects that all want some of the liquidity that you may have to offer?
Yeah, it's a great question. I mean, there's a few aspects there. It's kind of the exciting part of DeFi is that as investors, I mean, all of us, we're not just writing checks and, taking a slice of equity. You're getting involved as a user of the product where you're actively using the tool. You're becoming a liquidity provider, as you mentioned, also actively getting involved in the governance side. And I think that's what across the board here is really the value add, and that's where we're bringing options to the table. On the liquidity side, I think a lot of that we've seen, I mean, personally for us as a fund, is it's definitely adds a different dynamic to managing capital, right? Compared to a traditional venture fund, there's a whole different level of dynamics there. Like, what pool of capital do you have so that you can really deploy to these projects? And then how do you also switch that between them? I think generally the ones that really need liquidity are, it's at that early stage, right? It's that inflection point where you want to create some momentum. And if the project really does what you think it will, it'll attract liquidity on its own. And a lot of that is, other ways that we also add value, start thinking about what are the mechanics there, right? How is this competitive across the DeFi landscape in terms of the yields you're going to get?
Yeah, just to add on to that, I agree with what Nathan said. I think we kind of come at it as like the best way for us to do due diligence on any project in the DeFi space is to actually use it and really get intimate with it, because that really reveals like where it works well and also what its shortfalls are. And then that allows us to kind of iterate and give feedback to the team. But yeah, look, I think it's going to be a dogfight for liquidity in the DeFi space. And liquidity is very much like the lifeblood of these networks. And so, you can have a team that is very well capitalized on the equity side, but they don't have liquidity or a way of attracting users. Their project isn't well positioned. And then in terms of like how we think about deploying liquidity onto these protocols, we are profit driven, and we're seeking to maximize like risk adjusted returns. So we'll generally go to where the returns are highest, but with kind of a risk overlay. So we'll look at how long a platform's been around, our assessment of the kind of the integrity of the security, et cetera.
Can you hear me?
Yeah, we can. Yeah, much better, Vance. Yeah.
Cool. Yeah, I didn't hear the question, but I might be about. I think another, when you're a project and you're taking on an investor and you have some expectation as to liquidity providing from them, is to ask, how are they structured? Are they a fund? Is it SPVs? Are they a company? What are the expectations around their participation in the network? Because a lot of this stuff is just hamstrung by their LP agreements. And so if you have like any of these mega funds, like the $200, $300 million plus ones, they're just straight up not going to be able to provide liquidity in any meaningful respect to your network. And I think that, as a DeFi protocol, those are questions that you need to do due diligence on the investors instead of kind of the other way around, to understand what exact type of support you're going to get both sides.
Nice. And Vance, I think if you can get a little closer to the mic or something, we're still better, but we're still getting there. Yes, actually, Ben, one of the things you mentioned was like security. So I'm curious. I think we've all seen some issues with early stage DeFi projects. Like, how are you assessing? Right. I think one of the things that we've gotten good at doing is reading between the lines on some of these audits. Right. The audits are coming out and they're assessing the protocols. A, audits aren't going to catch everything, but B, it's kind of somewhat of the same dynamic that you see in the traditional audit space, like with the ratings agencies, right? Like they're getting paid by the projects. They don't want to come out and say like, this is like a complete insecure pile, right? Because then no one's going to hire them. So you kind of have to learn how to read between the lines. But like besides reading those audits and kind of learning to read the tea leaves, what are some of the things that you do to get comfortable with security before you make an investment, before you deploy your own capital into it?
Yeah, I completely agree on your audit, and I love that analogy to rating agencies. Look, I think the number one factor is Lindy effect. And the longer a protocol's been in the wild, and the more capital it's had in it, and the longer it's been around kind of without any negative events, I think is further increases our comfort. We're more hesitant to provide capital maybe out the get-go, and if we do, we generally start small and scale up over time as we get more comfortable. There's also insurance, like smart contract insurance you can buy on Nexus. So that's also a good way to mitigate. We're I think one of the larger purchasers of Nexus premiums. So like, I think there are ways to, and that, which also is not foolproof, because there are scenarios where certain smart contract hacks would not be covered. But look, I mean, I think there's no perfect system. There's no riskless way to provide liquidity to this protocol. So it's just about getting kind of gauging the risk and calibrating it. And I think it's probably more art than science at this stage of the industry, but I think it's coming along.
Speaking of art versus science, Ben, you and I talked about this the other day. I'm curious also for Nathan and Vance. One of the questions that I think comes up a lot, and Ben O'Neill mentioned this in the kind of pre-session, was how do you think about valuations, right? Entering into these things. One of the things that I think Masari kind of pioneered with the layer ones was talking about like 2050 market cap for things with inflation, or like looking at the fully diluted value. But often these things have small floats, and when you look at fully diluted value for some of these early stage projects, you get some like really big numbers that don't look anything like a traditional like seed or even Series A. So how do you start to think about like what a reasonable valuation is for an early stage or pre-launch DeFi project?
Try this one more time. If you can hear me.
Much better. You got it.
There we go. So generally, when you look at tokens, there's a multiplier in terms of their valuation versus an equity counterpart. And usually we see that that's anywhere from 3 to 5x what that company, if they raise just on safes or a price round, would be. And so the interesting part about talking to founders about valuation is, if they're an equity structured company and they're moving to a token model, you're basically telling them like, listen, you're going to own like a third of what you thought you owned. There's going to be a lot of inflation, which goes to the network, which you can earn, but you get liquidity. Your chances of actually monetizing your stake in this company go up drastically. And it's just arguably a better business model for a lot of companies. And so I think that's kind of like the first conversation we have with people, just to level set on expectations. And once you've kind of looked at the pie in this new way, and you've kind of chunked it up in their mind, and you can have a conversation about it, then comes, putting numbers on it. I think one of the things that isn't really discussed is like, what are these things really valued at pre-launch? And generally we see, 5 to 10 million. And I think if the code is written, numbers go up, and that's okay, but like there probably needs to be a good reason for that to happen. So I think that's generally what we see, and what we expect as founders to be on board with owning less of the fully diluted market caps, so that the community can actually grow and incentivize specific user behaviors.
Does that kind of match with what you guys are seeing too? Sounds like right ballpark.
Yeah, I think that range overall is exactly kind of what we're seeing out there. Another thing I'd add on top of that makes it interesting is because of the open market component of this, like you still have early stage projects that you're actually getting a real time active price on. And so there's a really interesting effect there that you didn't see in the venture space, right? With venture, you don't get that late stage active trading market until all the way at the end, which is also, I think, and I mean, in crypto, obviously there is hype cycles, right? We've seen a lot of early stage projects, especially 2 years ago, right? The valuations just went through the roof. So there's a lot of timing, and I think market cyclicality that goes alongside that. But it's always nice to be able to look and say like, okay, there's this project here that we've been following for the last year or 2 years. They made phenomenal progress, still pre-launch, but gives you a good idea of what a healthy valuation is according to the kind of community, and how that should back into what you'll see on the private side.
Okay. Yeah, I'll just add one thing. I mean, I think DeFi, more than any other kind of vertical within the crypto space, like actually has fundamentals. Like all these networks have earnings, right? You can look at price to earnings ratios. Some of these work tokens have PEs that are 20, 30, 40x, right? The aggregate earnings of major DeFi protocols are in the high single digits or tens of millions, depending on, when you look at it. So I think from so I think you can like apply more of a kind of a fundamental framework to looking at stuff in the DeFi space. I mean, these are all effectively on-chain businesses. So, and then I kind of incrementally, like I think the outcome or the distribution of outcomes for these investments is a little bit less of a barbell, like kind of a power law distribution, like similar to traditional venture, because like a lot of these DeFi protocols are producing products that work. There's demand for them today, so these networks produce earnings today, because there's effectively no cost structure attached to these tokens, right? So I think there's some. So I think there's more downside protection, I think, for investors, because there's some liquidity, and like a lot of these platforms are building stuff that's just real, that has demand. I mean, like look at Future Swap, and the volume it did in its first few days. So I think kind of the risk return for DeFi is, I think it's much more compelling than any other part of the ecosystem.
And yeah, just to add on to what Ben said, I think there's this feeling in DeFi that I'm starting to get, that you can kind of like right size these protocols to their use case and their addressable kind of fee market. Like, you don't need to go out and blitz scale like the shit out of like Kyber or any of these smaller DeFi protocols, just because like it's okay for these financial primitives to exist and they capture some level of value, but maybe they don't capture the entire universe. And I think there's still an open question as to like, is there like an M&A or verticalization play where like these smaller protocols get subsumed by like larger protocol use cases? So like an example of that would be, does Future Swap, which generates a lot of fees, a lot more in excess of what Compound does that effectively eat Compound eventually? Like, or does Compound need to go off and build a derivatives exchange? Like, there's just a bunch of questions in my mind about how that happens. But right now, it generally seems clear that you can right-size protocols not to like be $1 billion or nothing. You can have $100 million protocols subsisting and living on just on inflation and fees.
Yeah, I think one of my questions has been like, is Compound going to eat Balancer, or is Balancer going to eat Compound? Because I think, again, you've got people wanting to like passively hold probably multiple assets, and they may want to like kind of set it and forget it. And if they can boost their yield, earning both trading fees and like interest on lending stuff out, right? If I'm holding a basket of like 4 different tokens, and somebody wants to borrow in one and over collateralize in another, like, sure, have at it. It seems like we may start to see some of these things get mashed up.
Yeah, I mean, it just kind of gets back to, even if you look at GYDX versus Compound, the borrow and lend rates on GYDX are much higher. Like, how does Compound like continue to be a thing if you can get much higher borrow lend rates on other platforms, if there's more utility on other platforms? Like, I think, Compound specifically is going to have to figure out a way to iterate faster, even in a decentralized state, than it did in a centralized state, or else, any number of these protocols are going to come in and eat its lunch.
So like, I guess the contrast there is like Compound versus Aave, right? Like Aave is just kind of going nuts, just like adding new features all the time. What kind of risk discount do you place on that? Like,
heavy risk discount.
Constantly shipping.
Yeah, I mean, Aave is, who knows? Like, I love the project, uses Chainlink oracles, takes a bunch of the collateral that we like. So, obviously they're in the tent, and I love those guys. But, they're moving fast. They're adding lots of different collateral types. They're adding Uniswap LP tokens. Like, the blow-up risk gets higher for each new iteration you put in. And so, at what point does Robert's, like, slow and steady versus Stanny's, like, just blitz scale and win? Kind of like, at what point do those cross paths? I don't know, but it's going to be interesting to see, definitely.
Yeah, I mean, I think in the near term, I mean, Comp is airdropping $20 million plus of Comp tokens per year to users of the protocol, based on the latest round, which is likely the largest or one of the largest airdrops in the history of blockchains in terms of, over a 4-year period, it's 90 million is being given away. And so I think that creates a flywheel effect, right? Of you'll see interest rates being subsidized on the supply side of that market, because people are willing to earn less if they're getting these Comp tokens airdropped to them, right? And so you're going to see an influx of supply, I think, come onto Compound, just like you've seen with Balancer. And then you're also going to see an influx of borrowing, because rates are going to be lower on Compound because they're subsidized. And then you're going to see more value get sucked in, which in turn you could argue could make the Comp token perceived as more valuable if value is going up. which in turn could cause more capital to then come in. You get on this flywheel and you like think forward several steps ahead, and you could see just like a ton of capital getting sucked in because there's a $90 million subsidy over the next 4 years. And so that's, I think, where Compound has an advantage. Like they've been more conservative than Stanley, but I mean, and I think every liquidity protocol, like Uniswap, I mean, if you don't have a token, you're at a disadvantage, right? If you're not kind of, listening to Gavin's presentation before this, that was like really well done, right? Like if you don't have a way to incentivize participation, you're like in an equilibrium state, you're able to offer less to your users. They're going to go elsewhere. So yeah, I think it's going to be interesting. And I kind of see both Aave and Compound coexisting long term. That's just me, but
I think it's gonna be interesting when everybody has a token and it's like, okay, I can earn balancer tokens or I can earn Uniswap tokens, and like, what is it worth now versus what do I think it's worth in the future? And it's just like, you're effectively giving pseudo equity to a bunch of people and asking them to pick the winner in terms of like which subsidy is more valuable. I don't know which one will win. I feel like they'll coexist, but it'll be interesting to see. Like, just like airdrops were a thing back in 2017, like inflation is going to be the new thing now. And it's going to be really interesting to see it play out.
Yeah. I mean, what's the, like, I tend to agree with like Ben's assessment of like, we're going to start to see this like flywheel effect with some of these protocols. But like, I think, some of the awesome chat happening here, like on the chat session, Taylor is kind of jumping in there and having a good discussion with folks. Like, how do you, who are the users for the protocols like over the next few years? Like, is it like investors? Is it sophisticated users and whales? Like at what stage do we start to, is it even safe to suggest that we should cross the chasm and start getting more mainstream users using some of these protocols?
Yeah, it's a great question.
I mean,
that line is pretty.
Maybe just a quick sense check on these numbers, but my estimation of DeFi monthly active users is 25 to 50,000 people. Like, and I think that's being pretty generous. Yeah, probably extremely generous. Maybe it's half that size. But like these people are whales. They're effectively, they look like the foreign exchange bucket shop customers, like high value customers. High customer cost acquisition, pretty low churn rate, and they spend a lot. Like, at what point do those customers start to transition to kind of more of a mainstream audience? I think that will happen when kind of the continuing intersection of FX, which is foreign exchange, and crypto trading continues to kind of play out, because those two communities are very similar, and there's already a lot of overlap. And I think that once FX kind of trading really gets going in crypto, those will be the first users that'll come over. And that's probably another, 50 to 100,000 people. And then from there, it's less clear to me. But, those things happening are all predicated on either layer 2 success or ETH 2.0. And honestly, layer 2 feels like a better bet at this point.
I think on the institutional side, that takes quite a while, right? From a security perspective alone, it's going to be, even with custody, right, you start to see places like Coinbase, et cetera, starting to go towards staking protocols. But DeFi itself, you just have so many layers of risk. With that said, I think looking at it on a numbers base is interesting. But on the other side, you can also look at it where like these large early crypto holders coming from. And even the rise of WBT is pretty fascinating in that sense, where within, months, right, WBTC kind of didn't do much very exciting. A year ago when it launched, it was relatively uninteresting. Once Maker introduced it, and all of a sudden now there's the outcome there. There's that yield you can get with that Bitcoin. That value skyrocketed. And I think there's this interesting slow movement where you're going to have the people that are getting into crypto and are starting to believe in crypto, right? And they're putting significant amounts of money into it. And before you know it, like they're going to want to get those DeFi yields as well. And so I think that's the really the next big steps is you start with the people that are really into the early stages and interacting with protocols, and they're comfortable enough doing this. But as larger money moves into crypto, period, we'll start to see more institutionalized solutions to move that money in a safe way. So yeah, I think that could happen relatively quickly, though. We're starting to hit this tipping point.
Yeah, I mean, Nathan, I agree. I mean, look, I think big picture, like people are going to use DeFi because it's 10x better, faster, cheaper than like CeFi or the analog and the financial services space. Like, there's not $1 billion locked up in DeFi because like people are having fun. It's because like they feel like they can make money or do something better. And so, I mean, that's why, yeah, I mean, like the WBTC borrow on MakerDAO. I mean, if you can borrow at 1%, and lend out at greater than 1%, like that's tough to ignore, right? Or, you're seeing a lot of OTC shops trade stable coins on Curve now because, you're not taking security risk of a liquidity provider. And the slippage, I mean, you can do 500K bite size or $1 million bite size in Curve and get better execution than you can get on Coinbase. So I think we're getting to this tipping point where, DeFi is better than CeFi in certain ways. And you'll start to, I think, see CeFi firms start to use DeFi and start to kind of cross the chasm. But I think it's getting to the point where it's kind of too difficult to ignore, given how much cheaper it can be to borrow.
Yeah, I mean, I feel like one of the biggest stories was like that big WBTC mint where it was like Nexo Finance, right? And they were like, they're doing this like centralized like Bitcoin lending thing. Like, wow, we can actually just get much, much better rates using Maker. And so they minted a bunch of WBTC and now they're just getting like 5 points on the ARB there. So like, not bad. I think that's stuff like that's going to start to be the bridge. So again, I think Taylor's asking great questions about like the narrative about like, is DeFi ultimately for the unbanked? Do we ever, reach that audience? The way I got into crypto in the first place was I used to work in microfinance and so was looking at these unbanked populations and saying, how do we get them financial services? How do they serve themselves in ways that, use new technology to do things that couldn't be done previously? And I think we do get there, right? I think ultimately like that's one of my end games from being in this space is we now have an open financial system that's very nascent, very hard to use, a lot of risks. But ultimately, like if we get billions of dollars in liquidity in DeFi, which I think we're going to sooner than later, the goal isn't like just give people more ARB opportunities, right? Ultimately, what we're doing is building cheaper financial infrastructure that can be accessed by anybody with an internet connection anywhere in the world. So like I think my main question isn't will we get there? It's when is it safe to start pushing for that market? When is it like essentially ethical to encourage people who are living on a few dollars a day to put their trust in something that's backed by a system of smart contracts? I don't know. I mean, do you guys think that we get there, or do you think this remains?
Yeah, I think it's inevitable. I think the retail market is honestly the most exciting.
On a 10-year time horizon, right? I think we start to get there, but it's going to be. Sorry, can everybody hear me?
Yeah. You can go over Nathan. Go Vance. Nathan.
Sorry, I really can't see Nathan. He's frozen. I don't know when I'm interrupting him.
Go for Nathan. I'll hand it off to you. But yeah, what I was saying is on the retail side, the exciting part that I think people discount about DeFi is that you literally don't need to sign up. There's no case. Easier than getting a Coinbase account. And whether or not when we get to the unbanked, I think there's a lot of other questions, right? There's all of these issues with the unbanked populations. Do you have Wi-Fi access? Do you have cellular networks? Do you have a phone that's capable of supporting this? But I think all of the rails are starting to get there for consumer population to get into DeFi really easily. There's quite a few wallets that you layer into it. You buy some crypto with a credit card thanks to Wire and you're off to the races. And I think even looking historically, that's been the exciting part of where crypto's really boomed is through these retail populations. Every movement hasn't come from like the whales or the institutionals. It's become because people find it easy enough and eventually get in. And I think DeFi, it's inevitable. It's just a question of the full stack to get us there.
Yeah. I mean, I would say like someone on my team said this, DeFi is super banking the banked. So it's just I think long term it will bank the unbanked, but in the short term, it's basically just providing better banking services. two people in developed markets. I mean, if we're being realistic, I think most of the users of DeFi are probably in developed markets. They probably have bank accounts, and they're using DeFi because it's just better. I mean, we pay our invoices in stable coins in USDC because it's just easier. I mean, like there's an independent audit trail. You can't there's no lost wires.
Yeah.
I mean, Ethereum gas fees are expensive right now, but it's still can be. It depends if they're on the Silvergate exchange network, but it can actually be cheaper than sending a wire. So I think it's super banking the banked, at least in the near term, but long term, yeah, I echo what you guys said. I hope it banks the unbanked.
Yeah. Off that point, like sending wires, even the last few weeks, it's just it's such a hassle. Like
It's such a hassle.
they have to die soon enough.
Yeah.
We're gonna shake it up. Taylor's gonna hop in with us here. You thought you were done for the day, didn't you?
Well, then Lyra went to bed over an hour ago, which is just magical. So I don't even know what to do with myself right now.
I mean, come talk DeFi, obviously.
Right? But I mean, it has to be fate, because I think this is the first time in, weeks where she went to bed before 9 and I did not fall asleep with her.
Well done. So, I mean, Taylor, I have the question for you. So, you run My Crypto, which is, one of the OG ways to interact with all of Ethereum, but increasingly DeFi as well. When you're seeing all these new DeFi things come to market, how are you thinking about supporting it and the support tickets you're going to get and
Yeah, it's so our biggest concern and the biggest conversations that we're having right now are what DeFi do we want to enable and how do we want to enable it? On the one side, there's the argument that we should only add sort of the best and the most vetted and the things that have the, relatively speaking, lowest amount of risk. I think the compound is probably the one that gets thrown around the most in terms of being in the here's your risk scale and we're in crypto and compound is the lowest risk, but it's still it's outrageous relative to everything else. And then the other argument is enable everything and then educate users on what these things are and educate them about risk and what DeFi Score is doing and on and on. Yeah, I go back and forth though, because in this environment where your users are on Twitter, I think it's kind of easy to fall into this trap of building a product for yourself and the people that you talk to every day. And I just recall so strongly how quickly the audience shift happened in 2017. Whereas one day it was me and Alex Van de Sande and Nick Johnson, and that was it. We're all in the same sort of level. And then the next day we have just piles of support tickets of people who have no idea what they're doing. They're just sprinting and just hurling their money off Coinbase. And we're no, go back. And Coinbase is go ICO over there, And it was, I think that's what scares me, is because if we do enable these things and we don't do the impossible task of educating every type of user about every type of risk, then people are going to lose their money. And
So,
I might be traumatized.
Yeah. So I mean, I guess to that extent, guys, as investors, right? How do we all think about what's safe there, right? So I think obviously we're all advocates for the projects that we invest in, but how do you think about the balance between cheerleading those projects and also being realistic about the risks that they pose at the earliest stage?
I think you guys should just I think you get a bit of a pass if you are open about your VC status, because you're encouraged to be you should be a cheerleader, but the people reading your messages should also be well, I might want to research a bit more. They might
They may
have
have
to
back,
remote.
Yeah, I mean, I think, I mean, I'm personally a bit loud on Twitter, and I'm pretty upfront that I'm a VC. But you know, I think like a lot of us, I came from, you know, just speculating on crypto as a retail degen, like going long and getting liquidated and having fun and losing my money and playing on all the dangerous platforms and kind of doing my own research. And I expect that all of the people that are participating in these platforms, I mean, I expect them to do the same. And so, you know, I don't do a whole lot of hand-holding. Like if people want to read the audits, I encourage them to do so. But, you know, it's kind of the Wild West at this point, and people should be really, you know, expecting that type of experience. And bad things happen, smart contracts happen, you know, all these DeFi projects with impermanent loss or just, you know, just bad economics baked in the protocol, like, you know, bad stuff can happen. So it's not on our plate yet to educate people, but as we move to a more mainstream audience, it will be.
Well, okay, so we got like 5 minutes and then we got to wrap this thing up. So what I want to hear, you know, as we're all seeing an explosion of DeFi projects, right? Like hackathons, just like random projects that are like DMing you on Twitter and things like that. Like, how do you start to filter through this, and like, what are the traits that you're looking for in projects and founders that like help them rise to the top of the stack?
I think one of the things we start with is this something we'd be using? Is this something interesting? I think just there's an intuition that comes with being in crypto, right? And after a few years, you start to know what works and what doesn't. In 2017, there was so much of the opposite, right? It's like, oh, let's take Facebook and put it on crypto. Let's take Amazon and decentralize it. And now with DeFi, we're starting to see more primitives that really work, and it starts to stack and say, okay, how can we take this primitive and extend it that much further? So, so that's kind of our number one, like intuitive gut check. On the founder's side, I think there's this level of like hunger and persistence, plus they have to be whip smart, right? Just dealing with smart contracts and crypto, you're going to run up against obstacles and you have to be able to bulldoze through them, but also knowing that they have at the same time enough restraint that they're going to do it in a way that is, you know, secure and responsible.
Ben, you look, is that what you look for?
No, I agree. Honestly, I think Nathan said it pretty well. Yeah, I mean, I the only thing I would add is, I mean, I think it's always interesting, the new, like, kind of novel use cases that DeFi is opening up. So stuff like flash loans or just automated market makers, something like Augur, a decentralized prediction market, whether or not it launches V2. But it just different new types of products that unlock new use cases are always like quite fascinating. I mean, we can also rebuild the old system, but I'm interested in new stuff as well.
Vance, what are you looking for?
I can't actually hear or see Nathan, so I just have to agree with him on everything, or disagree. Either one.
Awesome. He says he's just going to copy all your bags.
Hey, I would.
I'm okay with that.
Taylor, what do you want to see? Like, what's a new DeFi project that you're like, man, we wish, like, if this were out there, like, our users would eat it up?
See, that's such a hard question, because users are going to eat up anything that promises them profits, which is why then, like, my mommy instinct like kicks in and is like, we have to protect them. We must educate them. You know, and
That's
so
how we got the 5 modal my crypto. Protect yourself before you use this.
Yeah. It's actually, it's 5 now. It was 10 originally.
It's like, it used to be a lot more than 5. Yeah.
And the buttons hopped around. Like, I worked hard to make that thing. Like, really, you were forced to read that. Yeah. And it's so I think there's a couple of things. The way I look at sort of the DeFi stuff. So there's this, like, okay, I'm going to talk about like low risk, high risk, but like just keep in mind we're like in this crypto risk spectrum, so not normal risk.
I'm going to talk about it in 1 minute.
Yeah, passive income, that's like low risk and steady. So you don't have like a liquidation risk. You don't have like a this is going to be worthless, et cetera, et cetera. Ways to take a user from the positions they're currently Euro, DAI, or ETH, and then understand what position they want, and then get them in like a passive income position that still maintains their original position. DeFi Zapper is now, they're starting to do this, but it's not 100% yet. And then just like fun things, leverage all the things, 100x, short and fiery pit, and or make all the money, right?
Infinite money code. The other one I want to see is I want to see someone productize the cash and carry trade, which has some centralized aspects to it. But I think that that is probably the central.
Wait. You got to define the cash and carry trade.
Okay, so in futures contracts, when futures trade at a premium to spot, there's an opportunity to sell the futures contract and buy spot. So you're perfectly hedged and you're just earning premium on that trade. And I think that, when we start to get into interesting products like dated contracts in DeFi, having some of that yield shift to the dated contracts and having a way that you can access, one of the central drivers of demand for leverage and creators of yield in crypto, like that is the thing that I want to see productized. Hopefully someone like Compound or Aave does it. But I think that would be a really interesting way for yield to be accessed by a large amount of people.
Nice. Yeah, I think we're starting to see some platforms come online that give you the building blocks to put that together. And so hopefully we'll start to see some either enterprising hackers or real protocol builders make that a reality. Awesome. Well, thank you all for hanging out and for just talking about how you're seeing the space. Taylor, thanks for letting us pull you in here to shake things up a bit. I'm gonna kick y'all out now, and then I'm actually gonna go off screen for a minute too. There's like this 2-hour recording window, but all of these folks, you can find them. I think their like Twitter profiles are linked somewhere. Just search them; they're pretty easy to find. And I'm sure everyone, if you're working on a DeFi project, hit them up. They'd love to chat with you.